Good morning, students. Wishing you all a very happy 77th Republic Day. I'm sure every one of you knows the significance of Republic Day. The taxation law that we are studying is one of the byproducts of the mother of all laws, which is the Constitution, which was born on 26th of January 1950. Also, if somebody has a confusion that somewhere you are reading 76, somewhere you're reading 77th. So exactly what is the correct one? Both are correct. The difference is we have completed 76 years of passing of the Constitution and making India Republic, and we are celebrating the 77th Constitution Day or Republic Day. Now you'll say, sir, how is this possible? Because in our case, when we celebrate our birthday, we are of, let us say, 10 years, and we have completed the age of 10 years also. Then how come there is such a confusion here? The answer is that in case of Constitution Day or Independence Day, we are first, like in case of Independence Day, 15th August 1947 is the first Independence Day. 26th January 1950 is your first Republic Day. So the day on which this happened is the first day. And then after 1 year, it is the second birthday of that, third birthday of that, fourth birthday of that. Whereas in our case, the day when we are born, we don't count it as one. That is 0. And after 1 year, we celebrate the first birthday and we are also of the age 1. So this is the difference why every year on 15th August also and 26th January also, there are two numbers which are parallelly used, and many times people get confused because somewhere they are reading 76, somewhere they are reading 77. But I'm sure you all have understood the difference in case if any of you had the confusion. And whatever laws you are studying, all laws are the babies, the byproducts of the mother of all laws, that is Constitution. This Republic Day was special because we had the European Union delegates coming, and the head of the European Union were our chief guest for this Republic Day. And today could be the day which will start a new economic world order, because today there is a very great possibility, rather it is as good as sure, that India will be signing a treaty, a trade pact, FTA, with the entire European Union, which includes all European countries. And this deal is by their side only called as mother of all deals. So we already signed with UK, which is no more part of EU. There will be, I'm sure you all would have heard Brexit. So Britain had exited EU, but we have already signed with that. We have already signed with other countries. And if this deal is cracked as per all the terms that we are looking for, or at least 90% of the terms, you will find something extraordinary happening after 2 to 3 years, when all these policy changes roll in, when all these trade changes roll in from either side. Plus, if you would have seen our yesterday's Republic Day parade, we displayed some of our indigenous and also newly acquired weapons. Some weapons are such where we are the country, not even America has that weapon, but we, China, Russia, only 3 countries have that weapon. So that itself is something to feel proud of. We are already seeing what great heights ISRO is touching. So these are some very relevant things. So on the security front, on the space front, on the trade front, we are going very strong. Now, we as chartered accountants have a bigger responsibility because remember one thing, students, whenever economy grows, the first person who is there to shoulder the responsibilities is the chartered accountant. In fact, when the economy is going downwards, again it is the chartered accountant who is the one who takes all the burdens, all the responsibility on its shoulders and ensures that the economy is again on track. Fortunately, we are not in the second phase, we are in the first phase. And after all these deals, I'm sure the economy that you will be seeing will be something extraordinary by the time you all are in your finals or you have qualified. You will see the bigger impact of all these trade deals. I will request everyone to kindly follow all these trade deals whenever they happen. Whatever data you get, you should study that data. You should know what is the deal involving. If by chance you want, you can also subscribe to various YouTube channels of UPSC coaching. So there are different UPSC coaching class YouTube channels. There you will get the most first-hand information because for them it is a subject. So many of these UPSC faculties, they keep on posting videos and they make most neutral videos and covering all important factual part. So this you should be aware. Most important, 1st February we have our budget, and prior to that you will have the economic survey report. See, these things you may find very boring. As a student, I also used to never read them, but later on when I realized the importance, because we are in that particular field where we, as I've always been telling, are considered as God of 5 subjects, and all those 5 subjects drive the economy. So anything relating to economy, you should be well aware of. And let me tell you, the moment you start reading this, the moment you start getting involved in the various discussions, news debates, various YouTube channels, you start getting the info. You will also start getting the interest in those numbers, in those analysis. And let me tell you, firstly, most important, it will help you select your right path. See, CA is a 8-lane highway. Why? Because you have those many lanes, which are those many opportunities. But the point is, out of these, on which lane you should put your vehicle, that depends upon your choice. It is completely your choice. But to take the right choice, you should be aware as to, firstly, you should know what are these 8 lanes. These 8 lanes are the new opportunities coming, new uh, venues coming. But for that, you need to be abreast with all these amendments, all these changes that are happening. So with this brief, no, Neeraj, it won't happen so soon. Don't worry. The optional tax regime is going to stay. Why? I'll tell you. See, ultimately, it is government's decision. So Neeraj is asking, sir, ki there are rumors that the optional tax regime would be removed. See, had that been the case, Neeraj, in the new Income Tax Act, because now it is starting from 1st of April, it is the new Income Tax Act which will be applicable for all incomes earned from 1st of April 26. Had that been the case, they would not have included the new regime, this optional regime or the old regime. They would not have continued so many sections in the new act, because now they do not want to make the act like this, that there are sections and after 1 year those sections are deleted. So again, those section numbers remain blank. They will not do that. And I'm sure by now there are so many sections in the optional regime, that is the old regime, which will have to be removed if you are removing the regime. So if I go by the logic, they will not be removing at least for next 2 to 3 years minimum. If they wanted to, they should have done it in the new act itself. but the new act has all the old provisions. This shows that their intent is still to continue, right? Okay, so with this backdrop and with a request that everybody should follow the news, the updates relating to economy, relating to all these trade deals, relating to the various sectors, like you would have heard that now India has also opened the most sensitive sector, which is your this nuclear sector to the private players. So these are some important things that you should know, because as I told you, the very first benefit of this is when you will embark as a chartered accountant in the market, you should know that these are the multiple opportunities available for you, right? Okay, fine. So let us start. Good morning, Linga R. Good morning, Neeraj. Good morning, Dhanalakshmi. Good morning, Diya, Aditya, Tisha, Harivansh, Neeraj. Yes, Nagaraja. So you're right. So you can subscribe to many of these where from where you get details. But as I said, na, I normally follow 2, 3 YouTube channels which are of various these UPSC coaching academies, and over there are very good videos posted regularly. And the best part is it is not only limited to economy. Like I take a lot of interest in geopolitics because that has a direct impact on us, first as a country, second as a professional. So all these things I get updated. So what is happening within the country on political front, on economic front, on legal front. See, even legal part you should be updated. So everything I get from these channels, right? So students, let us start. So we are in this topic of deductions. What are deductions? So firstly, there is a difference between deduction and exemption. So if something is put in section 10, which we call as exemptions, and in case of capital gain in section 54, both these are called as exemptions. But again, between 10 and 54, there is a difference which we discussed in capital gain chapter. And then besides 10 and 54, you have altogether a different category, which is section 80. So section 10 exemptions are those where if your income is covered in any of the clauses of section 10, there is no tax payable on that income right from the start. So exemption is something where your source, that income itself is outside the taxation net. You need not pay any tax on that. Section 54 exemption of capital gain is such that first you compute capital gain. In case there is a gain, then 54 gives you an opportunity of saving the tax by reinvesting. That is 54 benefit or 54 exemption. Then you have section 80 and section 10 double A. So 80, entire 80 is covered in chapter 6A, and then you have section 10 double A. This 10 double A is not an exemption, it is a deduction. We have discussed this in detail in our first class of deduction. So in both these cases, these are not exemptions, these are deductions, which means that whatever you are going to earn, first you compute your income as per the 5 heads. So I'll just write it down. So you have section 10 plus section 54. These are exemptions. Then you have chapter 6A and 10AA. These are deductions. Here, the income, the source is exempt. So you may not even compute. Here, after computation, if you get a gain, the section, now 54 means I mean all 54, B, D, E, C, F, everything. The section provides an opportunity of getting the benefit by reinvesting. Then chapter 6 and 10AA are deductions, not exemptions. Means these sources are fully exempt. fully taxable. You compute your income, you adjust the losses, you find out your GTI, gross total income. Then, if you have complied with the conditions in whatever categories you are falling in, of reinvesting, of depositing the money, investing your money in certain areas, or if you have earned certain type of incomes, or if you are certain type of person, then from this GTI, which already includes that income, some amount will be deducted, which is as per these provisions where you have satisfied all the conditions, and this will be deducted subject to some upper limit. And after deducting this, what is left is your taxable income. Now, on this taxable income, you compute your tax using the tax rates. Now, there are two tax rates, slab rate and the flat rate. So for some assessees, there is flat rate, like for companies, partnership firms, LLPs, and for individuals and for HUFs, you have slab rates. Plus, there are some incomes which have special rates of tax, like capital gain, long term under section 112 or 112A, short term under 111A, regular short term is under slab rate only, then winnings. All these have special tax rates. So wherever or whatever is the tax rate applicable to your incomes, as per that you compute the tax. Now from this tax you again get a deduction. This deduction is rebate or relief. Relief you would have studied under section 89 bracket 1 while you were computing salary income for gratuity, commuted pension, and rebate you will study under section 87A when you will be studying the chapter of computation of tax liability. So this is again a deduction, but the deduction from tax is called as rebate. The deduction from income is called as deduction only. Now, interestingly, when you are computing income from any head, for example, HP head, so you first take the receipt, where that is a rent that you are receiving. Now over there for that also there is a working to find out GAV, and from that you have deduction under section 24. So there is also a deduction at source level. Source level means when you are computing the income of each source, you deduct the expenses of that source. This is the first level deduction, and then on the basis of all these sections, the investments you have made or any special income you have, or if you are falling in some special person category, you have the second level of deduction here. And then this is the third level of deduction, which is from the tax amount. So this is what we had studied in our very initial class. We had discussed this. I'm sure you'll remember all of this. So this is the whole background of all different types of benefits that the tax laws gives you, which is either in the form of exemption or deductions or rebate relief. This is clear to all students. I'm clearing my screen. I hope everybody has understood all the aspects. Anybody, any questions on this basic part, students? Okay, great. So I'm clearing my screen. Okay, I will. Then we started studying deduction. In deduction, the first section 80A, then the section 80AB, 80AC, all these sections put in various conditions, put in various, you can say, rules for claiming deduction. Most importantly, majority conditions and rules are pertaining to this category of deduction, which is not part of your syllabus completely. So deductions under chapter 6A can be divided into three broad categories. Deduction for certain payments, where we have seen in many sections, you have to deposit, you have to invest, or you have to give donation. Two, Deduction for certain persons, which also we have seen a person who is physically handicapped, a person who is suffering from specified disease like this. And third, deduction for certain incomes. Now, this third category covers deduction where you have started your business in some backward area, in some northeastern states, or you are doing a particular type of business like hospital with 100 beds, infrastructure facility, housing for economically lower income section, or slum redevelopment. So all these businesses are listed, and all this third category of deduction is called as deduction for certain incomes, which is in the act falling in part C or heading C of chapter 6A. So we call it as heading C of chapter 6A, which covers the third category of deduction, deduction for certain incomes. Now, for this, there are many conditions majorly. Unfortunately or fortunately, it is not part of our syllabus at inters level, but these are the ones which are falling in this. Many of these sections have a sunset period. Sunset period means that there is a timeline when this section benefit will get over. So when these sections were introduced, they were introduced with some time frame, 10 years, 15 years. And now many of these sections benefits will be uh, phasing out because the period allotted to them will end, and that is how automatically these sections will be out. In fact, many of these sections are already out. We had a big series of 80H. Here you will not find a single 80H. So we had 80H, HH, and so many things. All are now gone. Why? Because they had a sunset clause. The period has ended. So that section sun has ended. That is why it is called as sunset. Means the benefit of the section is done away with. Out of these, we have only few incomes which are part of our syllabus that we are going to deal with in detail. Remaining all these sections benefit you will study at the final level. Most important point is you cannot carry forward the deductions. So whatever are your deductions under chapter 6A 10AA, you have to deduct it, you have to avail it right now. If there is any excess deduction which you cannot avail right now, your deduction will lapse. You cannot take it to next year and claim it in the next year. Then we started with the first deduction or the first category also. Yes, Aditya. I'll come to that, Aditya. Then Lakshmi, allow me a time. Let me first answer ATC and Aditya's question, then I'll come to your question. Also, a request everybody please put question which is visible to all, not to me direct, so that others will understand what I'm answering. Now, the first category of deduction, which is for certain payments, in this, the first and the biggest section is ATC. ATC has simply given you a list of various investments, which if you make, you get deductions. Now, when we are talking about ATC, what is important to be known is, and this you have to check in every section, that who is eligible for this deduction, point number one, whether that person has to be resident, point number two, point number three, what is the maximum limit, and point number four, obviously, what are the other conditions. Now, this section is giving benefit to individuals, HUF, but here they may be resident, they may be non-resident, because the condition of resident is not given. Second generic point, out of all the deductions that we are studying, only three are covered in the new scheme. So new scheme will give benefit only to three, remaining all are out of the new scheme. So all these section benefits will be available only when you are opting out of the new scheme. That is, you are in the old scheme, right? Understood by all? Fine. Now, what is the maximum limit? If you all remember, the maximum limit is rupees 150 for this section. But importantly, even though individually for ATC it is 150, if you remember, which we have solved also in the previous class, three sections combined also the limit is ATC. दीपा, एक बार देखो तो इतनी सुबह मामा जी ने क्यों फोन किया? 1 सेकेंड शूट्स। Sorry. So 150 is the individual limit of ATC plus three sections combined also 150. Now, what are the various amounts covered here? So that we will see, or various investments which are covered here. So one is investment in ULIP. In fact, if you remember, there is a very beautiful summary also, but I'm going from the detailed part only. So investment in ULIP, that is unit linked insurance plan, then unit linked insurance plan of LIC, then life insurance premium. This is the most important part. For life insurance, what is important to be noted is this date, 31st March 2012 or 1st April 2012, whatever is comfortable for you to remember. If the policy was taken before this date, up to 20% of the policy amount can be the maximum premium for which I will give a deduction. If the policy is taken after this date, 10% is the maximum amount of premium, 10% of the policy amount, which I will allow you as deduction. From 2013, for those who are suffering from severe disability, which you know is covered in section 80DD and 80U, or those who are suffering from specified diseases, which is covered in 80DDB. If for their benefit a special policy is taken, you will get up to 15%. So instead of 10, it will be 15 only for this category of persons. For everybody else, it is 10. Also, I'm sure you all will remember C for selfish. So this section gives deduction only for selfish family, which includes yourself, your spouse, your children. Children includes adopted child, children includes stepchild. So all are covered. Here there is no limit of two children, at least as far as life insurance premium is concerned. But when you'll go to tuition fees, which is allowed for children, over there you have benefit of two children. So when you talk about life insurance premium, only three persons life insurance premium is covered. If you are making payment for your parents, even though they are senior, they are dependent on you, no deduction allowed for life insurance premium. Similarly, for our brothers, sisters, grandchildren, nobody is allowed. Only these three people are allowed. Further, for these two people, whether they are dependent or they are independent on you, in either case, the deduction is allowed. So there is no condition of dependency also, right? Then we proceed. Then there are different types of deferred annuity plans. So these are also life insurance policies, but giving benefits in a different manner in the form of giving you annual payment. That is why they are called as annuity plans. So one is of private, one is of government. Then another important which you have studied in salary chapter also. Here, importantly, whatever you are contributing to SPF, RPF is only covered. PPF, anyways, only you contribute, your employer never contributes. But where your employer is contributing anything to SPF, RPF, you don't get deduction of employer's contribution. So your deduction is limited only to your contribution. Similarly, this also you would have studied in salary. Approved superannuation plan, again, only what you contribute is covered. See, everywhere it is your contribution, not employees. Then for female or girl child, there is a special scheme launched in 2014 where if you deposit money, you will be getting deduction. Plus, at the time of withdrawal from this scheme, whatever money is withdrawn, that is allowed as exemption. That is, there will be no tax on the amount that you will be getting back. Then this is like FD of government, which is a national savings certificate. Eighth issue, whatever you deposit, you get deduction. Again, annuity plan of LIC, some notified units of mutual funds or of UTI. Again, notified pension fund set up by mutual fund or NIC. These are not very significant. Nowadays, people do not invest in them. Then contribution to National Housing Bank. Then notified deposit scheme, firstly of that public sector company which is engaged in construction of houses in India. Then another which is engaged in giving you loans for housing. So it basically covers like HUDCO. So you can just remember the name, but again, not very important. This is important where your child is taking a full-time education in some university, college, or school, and you are paying the fees. Out of the fees, total fee receipt, if you see the fee receipt, even if you see your college fee receipt, there are different uh, particulars against which fees is collected: ground fee, iCard fee, library fee, some building development fee, some other fees. Only one fee is eligible, which is the tuition fees. But this tuition fees is not your private coaching class fees. It is the tuition fees of your child, which is paid to school, college, university, that also for full time. And here there is a limit of maximum 2 children. Nowhere else in this section, this limit is there, only in this section. Then when you have taken housing loan and you repay the installment, in the installment, the principal portion, which represents the cost of your house, is covered in ATC. The interest portion is first covered in HP and then it is covered in ATEE and EEA. Now here Dhanlakshmi had a question, so I'll answer Dhanlakshmi's question. She says in HP under 24B, 2 lakhs or 30,000 deduction is for every year. Yes, beta. So up to 2 lakhs, if all the conditions are satisfied, and if not, up to 30,000 deduction is allowed, and this is every year. Now, wherever you are covered in that 2 lakhs category, only then you can be covered here in deduction also. So up to 2 lakhs you claim there, and what is over and above 2 lakhs, you can claim here in ATEE or EEA that we studied, which we'll revise in a few minutes. So this is for the loan that you have taken for your house. Now important, what is not covered is while taking loan, if you have paid some admission fees or you had to purchase share in that housing society, these payments are not allowed. Similarly, the cost of addition, alteration, renovation of the house property after its completion certificate, that is a loan taken for future repairs, is not covered. And any expenditure in respect of its deduction is already allowed in 24. So whatever interest is claimed in 24 or any other expense which you have claimed in 24 cannot come over here. So these are some important points relating to your housing loan principal deduction. Then if you have invested in specific equity shares or debentures, that is eligible. Certain units or mutual funds are eligible. Now again, important is you have taken a FD. Now FD can be either taken from a scheduled bank or you have deposited in FD of post office. In both cases, the condition is same. The FD should be of minimum 5 years. Then the principal amount which you have deposited for FD is eligible. Again, purchasing some notified bonds of NABARD or depositing in senior citizen savings scheme, all these are eligible. Now, I come to Aditya's question, and this point I had left out last time when we were studying ATC because I had to teach NPS in ATCCD. Now, NPS is National Pension Scheme for which you already have a deduction in ATCCD. Now, if it is already covered there, then why are you covering NPS in ATC? The answer is there are two types of NPS, Tier 1, Tier 2. Importantly, what is always given in the sum is Tier 1. So ATDD, which is the main section for NPS, provides you deduction for the payment to NPS Tier 1 account, which is always the case. However, if you have contributed to Tier 2, which is in addition to Tier 1, then this contribution will come under ATC. And this is allowed only to central government employees, only they are allowed to invest in Tier 2. Now, what is this Tier 1, Tier 2? So basically, Tier 1 is the, let us say, a limit for which is applicable to everyone. So anyone who is investing in NPS, they are given a limit that, let us say, for example, and I'm not giving you the exact limit, I'm just giving you an example, up to 15% of salary is the limit, which is Tier 1. Now, if somebody wants to go beyond 15%, whatever they will contribute, that will go to tier 2. But if you remember, in 80 CCD, we studied this pension plan was originally started by central government only for their employees. Later on, this plan is of central government only, but it is extended to everyone, private employees also, state government employees also, and today people like you and me who are not employees. Now, for everybody else except central government employees, the tier 2 facility is anyways not available. So whatever we are going to invest is in tier 1 only. So the extra amount that if any employee wants to invest because he wants to get more pension at the end, he can do that, but provided the person is a central government employee. So what they invest over and above the regular limits of NPS is what is tier 2. But as we just saw, it is not available to us. It is only available if you are a central government employee. So that tier 2 investment, if central government employee is doing up to tier 1 limits, he will get deduction under 80 CCD. For tier 2 amount, he can get deduction under 80C. Anyways, if you remember, combined limit of both 80 CCD and 80C is 150 only. Then we studied what will happen if you terminate your insurance policy within 2 years. Then whatever deduction you are claimed in those 2 years will become taxable. Similarly, the ULIP plan, if it is terminated in 5 years, or the house property for which you took the principal amount deduction in ATC for the house property installment, if that is sold within 5 years, again, whatever deductions you have taken, that will be treated as income of the year in which you terminate this plan or in which you sell the house. Now, this is the summary of all these sections at one place, just for a quick revision. Then you have 80CCD. It is a pension plan, but of private insurance companies. Again, allowed only to individual. Here, HUF is missing because HUF are not eligible for pension plans. All these pension plans, annuity plans are limited to individuals only. Again, resident is not a condition. So resident, non-resident both can claim, and only if they are in the old scheme, that is, they have opted out of the default scheme. No other special point except that the limit of deduction independently of 80 CCC is 150 plus the combined limit of all three sections 80C, CCC and CCD1. CCD1 is your contribution, CCD1B is your additional contribution, and CCD2 is employer's contribution. So, but here the combined limit of 150 is applicable to your contribution, which is in 80C also, all items, 80 CCC and 80 CCD, and this limit is given by 80 CCE. So whenever you are taking the combined joint limit of 150 for all three, you should write 80 CCE. Now, whenever you will get money from this pension plan of insurance company, it will be treated as income. So the pension that you are receiving from such insurance company as per this plan, this pension will be taxable in your hands. So in the year in which the pension is received, that will be taxable. Next comes a very important scheme, 80CCD. 80CCD is having different aspects. Sorry. So I will show. So 80CCD has subsection 1, it has 1B, and it has 2. Now, 80CCD subsection 1 is your contribution. So you are employee. This is also your contribution. You are employee. Now, importantly, why there are two parts? Because for this first part, there are two limits. First limit is up to 10% of salary. And second limit is where along with 80C, 80CCC, the combined limit is 150. So when an employee is depositing money out of his salary or her salary in 80CCD subsection 1, he will get deduction up to 10% of salary, and the deduction also has an overall limit of 150 along with 80C, CCC combined. Now, if you are a self-employed, Again, for you, the limit is similar. The only difference is it is 20% of your GTI. And again, the maximum amount limit is 150 along with 80C CCC. Now, 80 CCD 1B, it is again your own contribution, that is employees contribution, but let us call it as additional contribution. Additional means over and above this 80 CCD 1. So if your amount is exceeding this 10% figure, let us say, and it is also exceeding this 150 figure, you can get additional deduction in 1B, and this limit is up to 50,000. Now, what is important is this part of 80 CCD, subsection 1, 1B, which is dealing with your contribution, is allowed as deduction only under old scheme. But this 80 CCD2, which deals with your employer's contribution. So interestingly, this is the first section which allows you deduction even for the amount which employer deposited. Generally, it is all sections like ATC, CCC, everywhere. It is your contribution only where you get deduction. But 80CCD subsection 2 gives you deduction for what your employer contributed. Firstly, whatever your employer contributed is part of your salary. And then here you get deduction. Now, interestingly, this deduction is under old scheme also, and it is under the new scheme also. So this is the first deduction of the new scheme, but only the subsection 2, that is the employer's contribution. Now in the old scheme, if your employer is government, then the limit is 14% of salary. And if your employer is others, the limit is 10% of salary. But under the new scheme, whoever is your employer, all employers, the limit is 14% of salary. So new scheme is having extra benefit mainly for the private employees, because private employees under old scheme will get deduction under this section up to 10% of salary, but under new scheme they will get up to 14% of salary. And let me again remind you, there are only 3 deductions allowed under the new scheme. This is the first one. I hope students, everything up to this point is clear. Yes. So everybody's questions, whoever had asked, I've answered them all. Let me proceed then. So I'm clearing this. So see here the deduction is given. So the quantum of deduction under 80 CCD1, which is pertaining to your contribution. For employees, it is 10% of salary. For self-employed, it is 20% of their GTI. Now somebody will say, sir, why they are given extra? They are not given extra. Employee get deduction twice. Firstly for their contribution, then also for their employer's contribution. In both places, they have 10-10, and in some cases for employer, they have 14. So employees are getting also 20% or 24% of salary as deduction, but half of. Since self-employed has no question of having employer's deduction, so they are given 20% at one place only. So this is what is the difference. This year in the budget, we are expecting some more relief under this section added for the new scheme people. So for the new scheme people, I'm expecting a change in this section in the budget. Let's see. Then comes 80 CCD 1B. So where you are making your own contribution and that limit of 150 is exhausted, you can still make it further up to 50,000 and you will get deduction under 80 CCD1. So 80 CCD1 is beyond that 150 limit. So here this point is given where deduction under 80 CCD1 is subject to overall 1.5 limit under 80 CCE, which covers these 3 sections. The deduction up to 50,000 under this is in addition to the overall limit of 150 given under 80 CCE. And then comes your employer's contribution. Your employer can be central government, state government, and even private employers. Now, in this case, under the old scheme, where government is making contribution, you can get up to 14% of salary. And when your employer is making contribution, you can get up to 10% of salary. But if it is new scheme, only this 80 CCD2 is allowed in new scheme, not the above subsection 1 or 1B. only new scheme allows subsection 2, that is employer's contribution, and it will be 14% of salary in all cases. That is whether employer is central government, state government, or private. Now, this is where we are expecting the benefit. So when this scheme will mature and you will get pension, the pension received from this scheme will be taxable if it is received out of the amount for which you have claimed deduction earlier. But where you are withdrawing lump sum, this lump sum has been given some exemption. The exemption is 60%. We are expecting this to become 100% this year in the budget. Let's see. So on withdrawal, up to 60% will be exempt. And when you are doing partial withdrawal, that is, you are still in employment and you are withdrawing, then up to 25% is exempt. So where the scheme is closed and you withdraw the amount, up to 60% of withdrawal is exempt, so 40% will be taxable. Where the scheme is going on and in between you are withdrawing, then up to 25% is exempt, balance 75% will be taxable. Next, where the withdrawal is being done by parent or guardian of a minor, in that particular case, there will be exemption on similar lines. So wherever they are doing partial withdrawal, they'll get 25% as the benefit. So benefit is similar. So this is how you get the benefit under all these sections C, CCC, CCD. Here, this is a very good summary given for remembering the limits of deduction under these sections. Then we go to the next section, which is 80D. Sorry, 80CCH, last section of C series. This section was curated when our Indian Army came up with a new scheme, which is the Agniveer scheme. Now, what is this Agniveer scheme? It is also called as Agnipath scheme. If you remember, we had some instances of physical, what you say, fight between our soldiers on the China border, where we, unfortunately, some of our soldiers martyred, but at the same time, we killed more of their soldiers, though that news never came out in the social media because Chinese government, everything is very much secret. But the point is, over there, our army realized that in that combat, when you have physical combat, that is fights like how you see in movie scenes, in that what is very important is that you should have people who are young, who are more energetic, who can run fast, who can climb, who can jump, which may happen only up to a certain age, because after that age you may be fit, you are good for army, but you may not be good for such type of physical combats because of the various uh, like jumping, high jumps, then crawling. Those things are required. Over there a very fit and more importantly a very young persons are required. So the army thought of bringing in new scheme of recruitment, which is the Agnipath scheme, and which initially, though it had some political issues, but later on, if you see now, this scheme is in fact benefiting us more. The second incident at Chinese border, which happened after we had employed people under the scheme, that is where we saw the results, and now that is why across India, this scheme is very successful. I'm right now not getting into the details of the scheme, but my earnest request is you all are also eligible to be part of the scheme, and you can join army for a short period after you complete your CA course. So you may just check out in case anybody wishes to serve the army for a limited period and get trained in all respects, discipline, combat, using weapons, all those things are possible in this scheme. So you may just check whenever you have time. Now the point is, for those who would join the army under this Agniveer or Agnipath scheme, they will get a benefit whereby for them again a similar like pension fund is created. This fund, let us call it as the Agniveer Corpus Fund. So instead of pension fund, because it is different from the above scheme, a different fund is created called as the Agniveer Corpus Fund. Now in this, the Agniveer, that is the soldier, is contributing 30% of his monthly Agniveer package. So you can say salary, but here they are calling it as package. And also your employer contributes equal amount. Now, interestingly, you are contributing 30%. See, and the best part is the entire contribution is eligible for deduction. So under NPS, we had up to limit of 10%, and in case of employer up to 14%. Here it is going up to 30% each. Now again, under subsection 1, your contribution fully is eligible for deduction, and under subsection 2, your employer, who is obviously going to be the central government, their contribution fully is eligible for deduction. And the important part, this is the second section where you get deduction even under the new scheme. But again, under the new scheme, what is eligible for deduction is only the subsection 2, which is of the employer. So your own contribution, which is under subsection 1, is not available, not eligible under the new scheme, but your employer's contribution is eligible under the new scheme as well. Again, whatever amount is received from this fund, whenever you retire after that short service period, that will be fully exempt. Next comes the D series, D for doctor. So this entire series deals with medical benefit. In this, the first section is 80D. If you remember, 80D, again, it is available for individuals and HF. Again, the condition of resident is not there. So both resident, non-resident are available, eligible. Again, this is available only if you opt out of the new scheme, that is, you are in the old scheme. Now here, what is interesting is for individuals, they have made two blocks. First is of selfish family. In that, you are covered, spouse covered, and here there is a condition that only dependent children will be covered. Second block is of your parents. Now, what is the importance of the block? Whatever is the limit over here, the maximum limit is 25 and 50, will be allowed to you twice. So firstly, for your selfish family, you can get deduction up to this. And then for your parents, again, you can get deduction up to this. Now, generally, as per whatever you'll get details in the practical exam questions, for your block, 25 will be eligible because none of you will be senior. And for your parents' block, 50,000 will be eligible. Now, in this particular case, if you remember the practical sum which we solved in the previous class, I had already covered this over there for your understanding that you have to claim this deduction by doing the working separately for yourself and for your parents. So see, 80D, first category of your selfish family here, the daughter who was independent, you were not eligible because here children should be dependent. I applied the 25,000 limit here, and then I went to parents block where I applied the second limit, and since parent was senior citizen in this sum, I applied the higher limit. Here, importantly, father was independent, still they are eligible. So the dependency condition here is only for children, not for spouse or parents. Right, students? Now, what are the payments that are covered under this scheme? So the payments that are covered under this scheme includes your medical or mediclaim insurance premium. It covers central government health scheme premium. So all these are health insurance policies. Similarly, other health schemes which are notified. So let me call it as notified health scheme premium. Plus, it covers, most important, premium for preventive health checkup. So it is like you go to this diagnostic centers and you get your different types of testing done, MRI, CT scan done, though there is no disease. So this is preventive health checkup. Now in preventive health checkup, what is important is 2 points. The individual limit of this is only 5,000, which is part of your overall limit. So within the overall limit, if you are having preventive health checkup, you can take up to 5,000, and here cash allowed. But for all the other payments, it should be non-cash. That is check, bearer, crossed, or online payments, all are allowed. But it should not be in cash. However, here in preventive health checkup, cash payment is allowed. Besides this, if there is a senior citizen, again, this will mainly apply to your parents, and they are not eligible for health policy. That is, medical claim policy is not given to them. Why? Because they are senior. So many insurance companies do not give them. Then you can get deduction for their medical treatment expenses, which will again be part of this block only. That is up to 50,000. So these are the various benefits under 80D. I hope you all remember this. Again, we have seen all this by way of practical sum as well. Harivansh is asking, sir, 80 CCD 1B total deduction. See, 80 CCD 1B independently gives you 50,000. So in 80 CCD 1, that is the main section, you get up to 150, but that is combined with 80C, CCC, and 80 CCD 1. If you have more contribution and you have exhausted that 150 limit under subsection 1, the balance you can come and take in 1B, which will give you additional limit of 50,000. Harivansh. Okay, so we covered all this. Yes, one more point in health insurance is many times people pay lump sum health insurance for 8 years, 10 years. This generally they do when they retire and they get some money of gratuity. So they know that maybe after retirement, they may not in future have money to deposit the premium. So instead, they make the lump sum premium payment of it. Now, in such cases where they have made a lump sum premium, here the deduction will be allowed by dividing the total premium by the number of years, so that you get every year's amount, and that amount every year they can claim as deduction under 80D. Then comes DD. Now there are two parallel sections, DD and 80U. Both sections have to be understood parallelly. DD is what, if you remember, I had mentioned it is D is dependent, the other D is disabled. So if there is any person who is disabled, either suffering from physical or mental disability, and either you spend on their medical treatment or you have paid under a special scheme of life insurance for such people, then you are eligible for deduction for this payment. So either you spend on their medical treatment, on their rehabilitation, on their training, or you have taken a special insurance scheme, either of LIC or of any other insurer, which is designed specially for giving maintenance to these people. Now, when you make any such payment, what is very important is here, for the first time, you get the condition that the assessee should be resident. So in 80CC, 80DD, 80U, and the next section 80DDB, in these three sections, the condition is the assessee should be resident, again, individual or HF, again, opting out of the old scheme. These are common points. What is very important is this scheme gives flat deduction. 75,000 if it is 40 to 80% disability. If it is below 40, there is no deduction. So 40 to 80 is called as normal disability. and 125 if it is severe disability, which is above 80%. So for severe disability, you get flat deduction. Now, what is very important is, irrespective of the amount spent, you spend 5,000, 10,000 on both these or any of these, your deduction is going to be flat. Most important, if you are disabled, you get deduction under ATU. If your dependent is disabled, you get deduction under 80DD. So for the dependent, if you are spending, deduction is 80DD. For yourself, if you are spending, deduction is ATU. And in both cases, the conditions, the limits, everything is same. Importantly, if there are more than one person who are disabled and dependent on you, still the amount remains 75 and 125. It is not per person who is disabled. That is not the case. Since this is flat deduction, it is allowed only to you fully, irrespective of the amount that you spent on each one separately. Aditya says, sir, in practical question, ATC, NPS. Beta, NPS, if ATC is given, you simply add it in the ATC list. So like how we solved, I'll show you. We solved a practical sum here last class, right? Here in this sum, I made a list of ATC. So if NPS Tier 2 is given, for example, you are given NPS Tier 2, simply add it here, NPS Tier 2. Let us say it is given 15,000. So you add it here and then compare it with limit. So your deduction will be more 15,000. That's it. So nothing special, na? But I see in this chapter, there is no special working. You have to simply tick, that is identify what all are eligible for deduction under which section, put it in the list of that section, check the conditions where it is available, where it is not available, that you check, and whatever is available up to the limits, if any, put it there, make a total and compare the total with the total limit of that section. That will become your deduction. Simple. Correct. Aditya. Done, na? Super. So I've been telling this, in this chapter, there are no special workings. In this chapter, the workings are zero. You only need to remember the conditions, for whom the deduction is available, what payment, what relation, what amount. That's it. That is the only thing that is required. Right? Okay. I'll clear this. Then you have 80DDB. Now 80DDB is for what? If you are suffering from any specified disease. Now here, most important, there is no ATU type of separate section. So whether you or your spouse or children or parents or brothers, sisters, only real, not cousins. So if any of these people are wholly mainly dependent on you, or you yourself are suffering from some specified diseases, then whatever you spend on the treatment of the specified disease, that expenditure incurred is eligible for deduction. So either it should be on yourself or any of these dependent persons, and who are dependent, their names are given. Correct? Now, interestingly, here there is a limit. The limit, not a flat deduction. This is the limit, 40,000 and 1 lakh. 1 lakh if the person for whom you are spending is a senior citizen. Now here an interesting point is, let us say you spent rupees 140. But now since this is medical expenses, let us say you had a Mediclaim, which gave you rupees 50,000. So what is your net expense? only that net has to be compared with the limit, whatever is applicable. So you'll not compare the gross. So if you have received some mediclaim amount, that has to be subtracted, and only the net amount, which is your expense from your pocket, that has to be compared with the limit. Here, this is not flat 40,000, it is a limit again. Again here, the person who is eligible has to be resident of India, and only individuals HF opting out of the new scheme are eligible. So this is the important point relating to 80DD. B. So I'm clearing the screen. Now coming to E. E for interest. Now the first section in this series gives you deduction for interest on higher education loan, which includes your graduation onwards all education expenses. So firstly, E for interest. Now all the E series only gives you deduction for the interest portion, not for the principal portion. Again, this is to individuals. The individual may be resident or non-resident because no such condition is given, who is opting out of the new scheme. Only they are eligible. And most important is the loan is taken for the purpose of higher education, either for himself or his relative. A relative includes spouse, children, and the person who is your legal ward, of whom you are the legal guardian, right? Here, there is no amount limit. The deduction for interest is for 8 years. 1 year, first year, which is the initial year, plus 7 years. Correct? Clear? Then 80EE and EEA both have to be studied together. Both are dealing with the interest of housing loan. So firstly, remember you first claim the main deduction in the main section, that is HP head. And if after that, because the 2 lakhs limit is exhausted there, any extra amount you claim it here. For 80EE, the most important is the loan should have been sanctioned in the year 1617. So for 1617 loan only, you are eligible for 80EE. Two conditions: the value of the house. Here they have not used the word stamp value, so it means the actual purchase value of the house should not exceed 50 lakhs. The loan should not exceed 35 lakhs, and you should not have any house on the date of this loan. If all those four conditions are satisfied, then 2 lakhs you have availed above in HP head, up to 50,000 you can avail here under this section. Similarly, moving forward, if your loan is sanctioned between this period, then you come in 80EEA. Here, the condition is the stamp duty value of the house does not exceed 45 lakhs. Here, there is no limit of loan amount, so that condition has been dropped. Obviously, 80EE you are not availing because you cannot get double deduction. And again, you should not own any other house on the date of this loan. Now here, besides the 2 lakhs limit, you get additional deduction under this section up to 150. This chart is very important, students, because it gives you a comparison of old scheme, new scheme benefit for entire interest. So entire interest, how much will be allowed in HP, how much will be allowed in Chapter 6A under old scheme, new scheme. It is given beautifully. You should refer this chart whenever you are solving HP head sum. And then the next interest is under 80EEB. This is for promoting individuals to purchase electronic or electric vehicle, sorry. Now again, here there is no condition of resident, so both resident non-resident can take. The only condition is you should be in the old scheme and the loan should be taken between this period, and it should be for purchasing electric vehicle. The loan should be from NBFCs or banks. Again, the deduction amount here for the interest portion only, not the principal, is up to 150. Perfect, students. See, Harivansh, beta, value of house in 80EE, where they have only said value, I clarified at that time itself. It means your actual purchase value. And here in EE, they are saying stamp duty value. So you will take stamp duty value, beta. So it is so simple. In double E, it is real purchase value, actual purchase value. In double EA, it is stamp duty value, right? So just allow me 2 minutes. Okay. Yes, correct. Now in ATG, what we had studied, G for God, and for God, there is donation. So that is how this section gives you deduction for donations. Now, what is very important is God is for all. That is why this is your first deduction, which is allowing you deduction for all assessees. So here it is not limited to individuals HF only, it is allowed to all assessees, right? So this section gives deduction to everyone. Again, obviously, who is not in the new scheme. So you have to opt out of the new scheme in order to avail this benefit of any of the donations. Now, what is important is donations are divided into two categories. One is donation to funds, second is donation to institutions. Funds 100, 50, 50 is only covering Prime Minister's drought relief fund. All other funds, national, central, state, prime minister, chief minister, all these funds are here. And in institutions, again, you have 150. 100 is allowed if you are for family planning or for sports development. And this is for all other social, religious, cultural organizations, right? What is important is here, there is no limit on the donation. Here, when you are giving to institutions, there is a limit. So this is broadly this section, which we understood in detail with a practical question. And that practical covered all the other sections. So students, I hope you have understood everything up to this point. So this is the list. So they have divided the donations into four categories. First is donations which are eligible for 100% and there is no limit, which is mainly covering all funds, central, national, prime minister, etc. Then you have donations which give you 50% deduction and there is a limit. This covers only one donation. That is for Prime Minister's drought relief fund. Then for institutions, you have 100% but subject to limit. And again for institutions, 50% subject to limit. 50% and 100% differences. 100% covers only two, family planning, and the other is sports development by any of these established notified sports bodies. Correct? Important point about deduction is deductions will not be allowed for non-monetary donations. So your donation should be in money form, but within money form, the limit is it should not exceed 2000 in cash. Then what is the maximum limit? The maximum limit is 10% of your adjusted total income. Adjusted total income is derived by taking GTI, and from GTI reduce all the deductions under chapter 6A except this section and reduce all special rate incomes. Further also reduce the income on which tax is not payable, that is exempt incomes. The balance is your adjusted GTI. 10% of adjusted GTI is your maximum limit. Most important, donation in kind not eligible, and donation exceeding 2000 if it is made in cash will not be allowed. So these are the most common, most important deductions. Now we will go to the remaining deductions which are left in this chapter, which are simple. Only in that 80 JJAA will have some application of mind, others are simple. Now, the next deduction is GG. Now, what is this GG stands for? I have given it an illogical logic. Gharghuti means relating to house. Now, what basically this deals with? It deals with rent paid for your residential house. So, if you are staying in a residential house, you are eligible for this deduction of the rent which you are paying. Now, pay attention. Now, this rent which you are paying, you may have already got a benefit. How? You may be receiving HRA because you are an employee. And over there, you have already got the benefit under section 1013A. Now, if this is the case, the law says we will not give such a person benefit. So the condition is The benefit is allowed only if you have not received HRA. Important. So condition is you should not be receiving HRA for which exemption under 1013A is available. This condition is the primary condition for getting the deduction. And as I already said, deduction is allowed for what? For rent paid for your residential house. So if you're staying in a residential house on rented basis, that is you do not have your own house, then you are eligible for deduction. Again, in condition, what is given? You should not have taken the benefit of exemption under 1013A, which is for HRA. Now, you should not occupy your own house. So that is, you should not be having your own house in that area, in that city where you are staying in a rented house. Now, this is where the condition becomes important. So let us say I'm in Mumbai, and in Mumbai, I already have a house, my own house, which may be owned by me, by my HUF, by my family. And if I show that I'm staying in a rented house, then there is a challenge. I will not get the deduction, right? Most important. If I satisfy all these conditions, how much is the deduction? Now you'll find that the deduction is very similar to what you studied in HRA. In HRA, how much was the deduction? It was least of three amounts. First was actual rent minus 10% of your salary. Here it is of your total income. Over there, it was 40 or 50% of salary. Here it is 25% of your total income. And over there, the third figure was actual HRA received. Here there is no scope of HRA received, so they are giving you a figure of 5,000. So deduction is very similar to what you studied for HRA. Over there also it was least of 3. Over here also it is least of 3. Is this clear to all students? So the working is exactly like HRA exemption under 1013A. On similar lines, we are working slightly. The percentages and the figures are different because over there it was computed on salary. Here it is computed on total income. Now again, what is this total income of which you are taking this percentage? This total income means your adjusted GTI, which we just studied for 80G. So what is adjusted GTI? It is GTI minus all other deductions under chapter 6A minus special rate incomes. That is adjusted GTI. Of that adjusted GTI, you take 10% and you take 25%. Fine, students. I hope this working is clear. Yes, Mustafa. So maximum you will get 60,000 in 80 GG because the amount limit is 5,000 per month. Correct. Nagaraja, if time permits, I'll definitely take example of this. But I fear it won't be possible. But don't worry, when we are doing the comprehensive sums, at that time, if possible, this will be covered there. Right, beta? Anyway, see, if you want an example, na Nagaraja, no problem. We'll do it here itself. 1 second. So if anybody wants to take a screenshot, may kindly do this. Chalo, I'm clearing the screen. Now we'll take the example given here itself for our understanding. Now see what example is given. So the example is that you are not a salaried person, because if you're a salaried person, maybe you may not get this benefit because you are receiving HRA and getting the 1013A benefit. So here the person is a businessman. Now, before allowing deductions under this section, what is your total income? The total income is 460, right? Which is before all other deductions. You have paid house rent, not HRA, sorry, house rent of 12,000 per month, and you are staying in Mumbai. Now compute the deduction available under 80GG if he has exercised the option of opting out. This is very important because if you are not opting out, then there is no scope of this donation. Sorry, deduction. Now, deduction is least of three figures. One is rent minus 10% of adjusted GTI. Then second is 25% of adjusted GTI. And the third is 5,000 per month. Right? Now, how much is your rent? Rent is 12,000. And your total income before this section, that is after all other deductions, is 460. So they have directly given you adjusted GTI. So your 10% will be 46,000. So 12,000 multiplied by 12 months is your rent paid minus 10% of this is 46,000. So this is your first figure. So how much is this figure coming to? 12 12s are 144, correct? No, 1 second. Huh? There is some point. 12,000 per month in respect of residential accommodation. Okay. Compute the deduction allowable to him if he has exercised the option of shifting out. Okay. So rent paid minus 10% is, why my amount is differing from their amount? I'm getting 144 minus 46. No, 98,000. I'm correct. Yes. Sorry. So first figure is 98,000. Second figure is 25% of adjusted GT. Again, 460 into 25% will be 115. So my second figure is 115. And 5,000 into 12 months, third figure is 60. So least of these three. So what is the least of this three? The least of this three is 60,000. As Mustafa was pointing out, you will get maximum benefit of 60,000. So that is correct. So I'm getting 60,000 as the least of these three figures. So my deduction under 80GG in this sum, Nagaraja, will be 60,000. Correct? Perfect. It is simple. It is very similar on similar lines of HRA. The only thing is over there, the percentages are different. Here, the percentages are different. Now, this next section is very simple. This next section is giving deduction if you have given donation for some specific purpose. Now, what are these specific purposes we will see. But again, before that, an interesting condition is put is that you should not be claiming deduction under PGBP, or you should not be having income under PGBP. Now, why this type of condition is put that you are not having income under PGBP? For the simple reason that, pay attention, the important and the interesting point is that those who are having PGBP head income, they would have already claimed this deduction under PGBP, because if you remember, PGBP has deduction for scientific research, for rural development. Over there under section 35 different sections, you are already getting deduction for this. Hence the condition put over here is that the assessee is not having any income under PGBP. Again, the same condition, you should have opted out of the default regime, that is you are in the old scheme. Now, what are the different donations or payments for which you will get deduction? So one is firstly, as usual, scientific research. Second is again scientific research. So basically scientific research paid to national laboratory, paid to university, college, etc. Then second, where your donation is for some rural development program which is approved. So this is, as you can see, the sections are of PGBP only, 35CCA. Fourth is where there is any eligible project. What is this project? The eligible project, if you remember, is the project for upliftment of socially, economically backward section of the society. So if you are carrying out any such project, that is also eligible over here. Rural development, or National Urban Poverty Eradication Fund. All these are eligible for deduction. All these donations are eligible. Conditions: you should not have PGBP income. You should not have claimed this amount as deduction under any other section. And again, if the donation exceeds 2000, it should not be in cash. So it is nothing but similar condition of PGBP put here. This is available mainly for salaried persons or those persons who are not having business head, so they could not claim deduction over there. So they are given deduction over here. Is this clear? Super. Now, okay. Yes, madam. Now, an interesting section is GGB and GGC. Now, for God, you had 80G, but political parties require multiple. So what you give to God, you have to give 2x times to political parties. That is why you have GG. And interestingly, students, you have two sections. One is GGB and the other is GGC, because the two biggest political parties of India are B and C only. I cannot name because unnecessarily it will be a different political issue. But just to remember the section number, this is the illogical logic. So GGB and GGC both gives you deduction if you are making payment. Now you can call it as contribution or donation to political party or that electoral trust or the electoral bonds. So when you make payment or contribution to a political party or electoral trust or electoral bonds, you are eligible for deduction. Now, if you are company, Indian company, you get under GGB. And if you are other than Indian company, non-corporate, that is individual, etc., you will get deduction under 80 GGC. So both sections gives deduction for donations made to political parties. So as they have explained the term contribute, so contribute will be donation subscription, right? Which is given to a person carrying on activity which is likely to affect public support for a political party. Or second, you are directly incurring expenditure. Expenditure incur in what form? In the form of an advertisement in any publication of the political party. So in short, directly, either you are giving them donation or you are putting your advertisement in the pamphlet publication of the political party, you are eligible for the deduction. Two sections, GGB, GGC. GGB is where the contributor is Indian company. GGC, where the contributor is other than Indian company. So you can see here, see GGC. So GGC will allow deduction to whom? Where the contributor is other than Indian company. What is very important to be noted here is the contribution cannot be by way of cash. So here no cash donations are allowed, right? So both sections gives deduction for political parties, but other than for cash payments. Who is a political party? So a political party is the one who is registered. So if you are registered under the respective act, which is applicable for political parties, in that particular case, you are eligible for deduction. Again, the deduction is allowed only under the old scheme and it is not allowed under the new scheme. I hope this is clear to everyone, students. So this is what is GGB and GGC deductions, correct? Harsh is asking what is 115 BAA. See, the new scheme. No, but I understand that. That is why I never take names. I am aware of that, Mustafa. So I've never taken any names of any political party or any political person. Yes, Harsh, I'm answering you. So, see, the new scheme which we are talking about has come in different parts. It has come for individuals HF separately. It has come for companies separately. It has come for cooperative separately. So all these section numbers that you are seeing, 115 BAA, BAB, all these are the schemes for the other persons. And for individuals, we have 115 BAC. So that is why you are having these different section numbers. All these are section numbers for different persons. So I'm sure here you are asking, what is this 115 BAA BAB? This is the new scheme section for companies, correct? And for individuals, it is BSc that you have been studying. Yes, Nagaraja, unfortunately, no limit. Because anyways, you can understand, section is created by political people and it is for benefit of political parties. So if you read both together, created by political persons and for benefit of political parties, you'll understand why it is like this. Now this is a slightly bigger section. I'll take it after the break. But before going in for a break, let me take a smaller section. Now, this is again going to be interesting. QQB, the full form that I've made for Q is Hindi Q. Q. Q, my books. So this is the question you are asking to authors. Why? Why did you write books? Just imagine, hypothetically, had there been no books, correct? No books, what would have happened? Harsh, I'm saying full form of QQB is Q Banai books. So this is the question that you ask. You ask to whom? You ask to authors. Now just imagine hypothetically, had there been no books in the world, nothing would have been written. As a student, your life would have been so easy and comfortable, right? So just illogical logic, the benefit under 80QQB is given to individuals. And here again, you have a condition that the individual should be resident. Now, what is the deduction? The deduction is for one of the income. So it is our third category of deduction, which is for certain income. What is the income? Now see, whenever an author writes a book, the author receives royalty. So whatever is the royalty income of the author, that is eligible for this deduction. Now, what is the income which is eligible? So they are using the word, either it may be a lump sum consideration or it may be a consideration which is basis per book sold. So both are eligible. So income may be by way of lump sum consideration and it is for what? For assigning the copyrights. So it is nothing but the royalty that you get. So as an author, when you get royalty, you are eligible for this deduction. Now, what could be the nature of books? It could be literary book, like literature that you read, or something of arts and science. In all these category, whatever you have written and for which you are eligible for royalty, or you can call it as copyright fees. So whatever you call, nomenclature is not important. This is what is eligible for this deduction. Now, the deduction has two limits. One, the 3 lakhs amount which you saw above, but besides 3 lakhs, there is one more limit which is 15%. So where you are being paid royalty per book sold, and let us say the publisher is giving you 20% as the royalty. So the percentage fixed by publisher is 20%. You will be eligible only up to 15%. So there are two limits. Percentage wise, your percentage should not exceed 15, and amount wise, it should not exceed 3 lakhs. So both things together combined becomes the benefit of this section, which is 80QQB. Again, this section gives benefit only if you are opting out of the new scheme. So those who are in the old scheme, only they are eligible, but important resident is the condition. Students, I hope this section is clear to everyone, what is covered in this section. It income shows before computation under iOS. No, but it is always income after computation under iOS. Harsh is saying, I'm asking about 115BAA. Okay, if you're asking about Harsh 115BAA, it is the section of computation as per the new scheme applicable to companies. So like for our individuals HF, the scheme applicable, the new scheme is under 115BAC. Similarly, for companies, it is 115BAA. Fine, beta, Harsh. I hope now you would have got your answer. So we are discussing this particular section QQB, which deals with royalty earned by authors or joint authors, right? Now there is a similar section to QQB, that is RRB. Now what is 80 RRB dealing with? It is again dealing with royalty. The only difference is here the royalty is received when you have invented something. So here your income is royalty income. Royalty income is because you are allowing me to use your patents, and you all understand patents is for what? Patents is whenever there is some invention, you get the invention patented, right? Again, this section also gives deduction to individual, and again the same condition like previous section, the individual should be resident opting out of the new scheme. So under old scheme, a resident individual, here you can call them as the inventor or the patenter, who has earned again royalty by giving his patent. Now here again, the maximum limit of deduction is 3 lakhs, but importantly, there is no 15% limit like the previous section. So previous section has 15% also. Here we do not have that 15% condition. We only have the maximum lump sum limit of 3 lakhs. I hope this is clear to you all, students. Any questions, any doubts in any of these sections? So both are similar sections, QQB and RRB, right? QQB is for authors, so you can easily remember Q banai books, that is QQB. RRB is royalty with respect to patents. Fine. Excellent. So now, so it is a 10 minutes break. We come back after 10 minutes to complete the remaining sections. Nagaraja is asking QQB furnished compulsory. What is this furnished compulsory, Nagaraja? But when you are asking questions like Harsh is saying before 1403, then I'm not getting what is the relevance. I'm not getting the relevance of your question, students. Kindly make it more elaborative. Fine. So we take a 10 minutes break. We rejoin after 10 minutes. Fine. Thank you. Let us continue, students. Sir, when company distribute dividends, it is given after deducting tax. See, beta, Diya, any income given is having TDS. If I'm correcting myself, any means many incomes. So, many incomes, when they are given, the law says the payer will deduct the tax. Now, it does not mean that if the payer has deducted tax, you are absolved from the responsibility, because the tax which is deducted, which is called as TDS, which you will study very soon in the TDS chapter, is only an approximate amount where a fixed percentage is given 5%, 10%, 20%. But we don't know actually what is your final tax. So, I am deducting your tax while paying you. It may be interest, it may be dividend, it may be salary. You include it in your computation, you find out tax liability, and from that tax liability you will deduct the TDS which I have already deducted and paid. So you will not be paying double tax, because the TDS which I have deducted will be allowed to you as a deduction from your final tax liability. Harivansh, sir, in 80 QQB, is the deduction percentage 15 or the royalty income up to 15% is deduction? See, 15% of royalty is the max. Sorry, I'll correct myself. The rate of royalty up to 15% is the deduction. So as I gave you example at that time only, publisher has given is committed me to pay 20%. Now this percentage is of what? This percentage is of the book sale price. So if the book is of 1,000 rupees, it is sold for 1,000 rupees, and the royalty percentage is 20. The publisher pays me 200 rupees per book sold, but I will get deduction only of 150 rupees per book sold. That is what the percentage is, Harivansh. Aditya, sir, mutual fund comes to capital gain, but how it comes to ATC? See, Aditya, please understand. In ATC, when you are depositing the money, investing the money, that is when you are purchasing the mutual funds, of the cost of the specified or notified mutual funds, you get deduction. But when you sell them, what you get becomes your income under capital gains. So both are different things. I hope I could clear everybody's questions, right? Now, this section, if you remember, I had mentioned at the time of explaining you the practical sum, which we did in the previous class, that ATTTA is an important section which you should keep in mind whenever you are doing a deduction sum. Again, same point, ATTTA is allowed to individuals HF who are not in the new scheme, who have opted out of the new scheme. Now, what is AT? I know, beta Mustafa. Let me complete the smaller ones. I remember everything. Don't worry. Correct? Yes, Diya. See, understand one thing. Company and shareholders are different entities. Company is earning by doing their business. Now, out of that earning, when the company pays you something, which is your another income. See, it is like this. Company is in your rented premises. You have given the company the premises on rent. Now, in that rented premises, the company does business, earns income. You ask the company to pay tax on their PGBP income, but the company is out of their income only paying you rent, paying the employee's salary. Will they not have to pay tax? Answer is yes. Okay, you may say that, sir, but on the same profit which is used for giving dividends, the company paid 30% tax. I agree. But the investor, the shareholder, and the company are two distinct persons. Shareholder is not earning by doing the business, shareholder is earning by investing. So the nature of income of shareholder is different from the nature of income of the company, and hence the shareholder again pays the tax. Okay. Now, what is this deduction all about? Again, it is only allowed to people under the old scheme. It is for individual HF. Now there are two sections, ATTTA and ATTTB. The difference is 80 TTB is if you are a senior citizen. So for senior citizens, the deduction is under 80 TTB. Now, what is this deduction for? The deduction is if in your income you have income by way of interest. Interest on what? Interest on saving bank account. So firstly, we include it in our other sources income, and then by ourselves, because here no investment, no payment is required. Simply your income has this income on savings account interest up to 10,000. Oh, in your IFOS, that is income from other sources, whatever is the interest received, let us say 15,000, 25,000, 30,000, entire will come as income. And then below in chapter 6A, you will deduct 10,000 as deduction. Now, if your income is 8,000 above, you will deduct 8,000 because 10,000 is the maximum limit. Now, what is the difference between TTA and TTB? TTA gives deduction to people who are not senior, because for senior citizens you have 80 TTB. Now 80 TTB, there are two special points. First, it is for senior citizen. Second, it is for savings plus FD interest. So here both interests are eligible for deduction, whereas here, sorry, which is for non-senior, only savings interest is eligible. Correct. Second thing is here the limit is 10,000 in 80 TTA, whereas when you go to 80 TTB, the limit is 50,000. And as I said, it covers both interests. It covers, so see, firstly, it covers people who are resident and 60 years of age, and it covers both FD and saving bank account interest. So this is what is 80 TTA and TTB in simple. There is nothing else in this section. Correct? Clear to all? Understood by all? So keep this in mind. This section you should always write by yourself whenever you are solving comprehensive sums or deduction sums. Write it. Whether you get or deduction or not, you'll write nil. But why this is to be written? Because in 90% of the sums I have seen, you have this income, that is interest. And in all those sums, by default, you should take this deduction, obviously, if you're in the old scheme. That is obvious because new scheme is not having this deduction. Correct, students? Clear? Anybody wants me to take a screenshot? So I'm clearing the screen. And then we go to the last deduction section, which is 80 JJAA. Now, what is JJAA? JJAA is Do Gulam Do Ikke. So Gulam and Ikka means employer, employee. Now, what is this section basically dealing with? So this section was basically introduced with the intention of increasing employment. Now you'll say, sir, how can a section increase employment? So the answer is pay attention. This section will give you deduction for 30% of your employee cost. Now, interestingly, what is employee cost? Employee cost is wages, salaries. Interestingly, this section gives you double deduction. How? You're already in business. So you have already claimed deduction of salary, of wages in your PGBP income. That is already allowed by section 37, which is the general deduction section. You can claim deduction of salary and wages. What is interesting is out of that salary, whatever is the additional employee cost, that will be allowed to you as deduction again. So let us say your salary is 25 crores in this year. You have already got PGBP deduction. Now, out of this additional employee cost, why it is not writing? Out of this, your additional employee cost is rupees 10 crore. So 25 crore, you already got deduction under PGP, section 37. What is happening to my pen? Right. Now, out of this 25, 10 crores, which is your additional employee cost, you will get deduction of this. How much? 3 crores, 3 crores, 3 crores. That is 30% in 3 assessment years. So out of the total employee cost, you have to find out what is additional employee cost. First, the total employee cost is already claimed as deduction under PGBP. Out of that, whatever is additional employee cost, 30% of it is allowed in 3 assessment years. Harsh, so you asked what are the 3 sections under which you get deduction under the new scheme. 1, your NPS, employer's contribution. Second, Agniveer, employer's contribution. And third, the present section which we are discussing. I'm yet to mention that, but since you have asked, I'm mentioning this is the third section, ATJJAA, where you get deduction under the new scheme. So these are the only 3 sections. Neeraj, just allow me 2 minutes. Additional employee cost, I'm coming. Let me give you all firstly the practical insight about this section, then theory conditions are always going to follow. So basically, the ideology is to promote this employment generation. Now, how employment generation will be promoted? Because they have used the word additional employee cost. Now, this name itself suggests that who will be additional employee? Those who are joining fresh. So I already have 100 employees in the last year. If I have 125 employees in this year, it means 25 who joined new, who joined fresh. Their wages, subject to some conditions and parameters which we are going to study, will be allowed as deduction under this section. That is why out of total wages of 25 crores, only the additional employees, that is the new employees who have joined, their wages will be eligible under this section, that also up to 30% every year for 3 years. So if my additional employees wages is 10 crores, fulfilling all the conditions of this section, then 30% is 3 crore first year, 30% 3 crore second year, 30% 3 crore third year. Now, interestingly, this is data of a particular year, let us say 25-26. Now we will come in 26-27. Again, now you had 125 employees in the previous year, 25-26. Now you have 140 employees. So you have hired 15 more. So again, this 15 more employees cost will be additional employee cost subject to other conditions satisfied. And this will be allowed as 30% from that year up to 3 years. So what will happen in the second year? You already have the second installment and a new 30% of the second year will also come. So this was in 25-26. This is in 26-27. This is in 27-28. Right? Clear? Understood? Now coming to the theory part, the conditions part. Now, to whom does this section applies? Its section applies to everyone to whom 44AB applies. Now, what was 44AB? 44AB was tax audit under PGBP. If you remember, when we were studying other sources at that time, I had taken few sections of PGBP, out of which one section is maintenance of books, another section is tax audit. And once you cross a particular turnover, you are liable to compulsorily get your books audited, which is called as tax audit. So whoever is running business and is liable to audit over there, they are all eligible for this deduction. Is this fine? Now, coming to some important pointers. Now the conditions will start. I'll just clear my screen, students, for ease of. Now, what are these conditions? See, the business should be a new business, not formed by splitting up of old business. So that should be a new business. Second, again, the assessee should not have acquired it by way of purchase from any other person. So if somebody is closing his business and you purchase from them, again, it is not a new business, not eligible. And third, now since you're liable for tax audit, you have to get the tax audit report from the accountant. Accountant is the chartered accountant and furnish the report before the due date of filing the tax audit report, which is 30th September of every year. Now comes what is additional employee cost. So for additional employee cost, you have to first understand who is additional employee. So additional employee means what? In case of an existing business, now I already gave you example. My previous year employee was number of employees was 100. Now this year I have 125. So 25 is additional, but all 25 may not be additional. Why? Because there are some criteria, but additional is the new employments. In the next year further, I have total employees of 140. So this 15 above this 125 is my additional. So what is additional employees? Now they are answering it negatively. The additional employee cost shall be nil if there is no increase in the number of employees. So in other words, from this negative sentence, you get what is positive. The positive is there should be new employees joining. Harsh beta, why assessment year previous year? We are talking by financial year. So first financial year was 24-25 when I had 100. Second financial year is 25-26 when I have 125. Third financial year is 26-27 when I have 140. Neeraj, sir, what if we every year hire new employees? So the cost will be additional? Yes. So that is what the government wants. You hire more and more employees, increase your employee base, we will give you deduction. So if you have that much work to absorb the new employees, you hire them. I'll give you deduction. And this deduction will continue for 3 years. 30%, 30%, 30%. Now, firstly, so you should have increased the number of employees. Second most important point is they should be paid only by the account pay check or the prescribed electronic medium. It means if you are making payment to them in cash or cross check or bearer check, we will not count that as additional employee cost. Now, importantly, if this is your first year of business, this is very interesting. All your employees are additional employees because previous year was zero because you were not in business. So first year all employees are additional employees. Now out of all this new employees or additional employees, everybody's salary is not eligible. Why? They have put some criterion. What is the criterion? I do not want the top class employees. Means I do not want means I as income tax will not give a deduction for salary paid to top class. I want you to increase the base of lower level employees. So that is why the first condition is your total salary of employee should be less than 25,000 per month, 25,000 or 25,000 less. So if you have hired new employees, but their salary per month exceeds 25,000, you will not get this benefit for those employees. Then again, those employees whose entire contribution is paid by government under the employee pension scheme in accordance with the Employee Provident Fund Miscellaneous Provision Fund Act. So where the government is paying their entire contribution. Now this will happen only in case of some specific central government employees. So for them, you will not get any deduction. Next, if you are not having RPF, that is you are having URPF. So if you are not having RPF, you are having URPF, we will not give you deduction. And then comes the most important condition. Now see what people will do to take undue advantage of this. They will hire employee and after some days they will retire them. Again, they will hire another employee and retire them. So this should not happen. So they have put a criterion. The employee whom you have hired should be working with you for at least 240 days in the year. And if it is a seasonal business, then for at least 150 days in the year. So 240 days is for regular employment employees, and for seasonal employment employees, they should have worked for 150 days in a year. Now, an interesting situation. What if I hire the employee somewhere now in January? and we are on 27th of January. Now hire a new employee. Will he complete 240 days in this previous year up to 31st March? Answer is no. That is where the note comes. So the note says that if you have not completed 240 days, 150 days in the first year itself, then I will give you this deduction considering the employee as the new employee of the second year. So when this employee continues his employment with me in second year, if he completes 240 or more, then he shall be deemed to be the new employee of the second year. In short, you will get deduction for this employee starting from the second year. Now, emoluments means what? Because I'm going to pay you 30% of the additional employee cost. Cost means the salary, which is over here used as emoluments. Now, what is emoluments or salary? It means any sum paid or payable to employee against his employment. So it simply means salary, but it will exclude what? Contribution paid or payable by employer to pension fund, provident fund. Now we all know employer contributes to a provident fund, that will be excluded. Further, any lump sum payment amount paid or payable to the employee at the time of termination, like his gratuity, superannuation fund, all this will be excluded. So only the regular fees, regular salary of the employee is eligible. So this is how, students, you will find this deduction. So I hope you have understood this. And the last and the most concluding point, this section allows you deduction irrespective of the scheme. It means this is the third deduction of the new scheme. Perfect. Yes, Neeraj, 100%. ICAI members and ICAI is always contributing to every government initiative. In fact, our president, sir, and our committee body members are also on their committee. And most importantly, they take our consultation before any budget and any major change they want. So we always, as ICI as a whole, contributes to this budgeting process. Our recommendations are always taken. This is done already in November, December, right? And right now the budget is already finalized because it has to be presented on 1st Feb. It would be under printing stage right now. That means correction and printing stage, proofreading stage. Fine. So students, with this, we conclude today's session here. As I had informed, today we have a national conference and I am allotted the first opening session. So I'm just leaving you 7 minutes early. Anyways, we have completed this whole deduction under chapter 6A. I request everyone to please study the chapter. It is fully scoring. The only thing is you have to remember the minute pointers. Fine, students? So thank you for the day. Take care. Thank you very much. Thank you all. Thank you.